Welcome to Livewire Markets. My name is Vishal Tekshanani. Thank you for tuning into the pitch. My friends, we are in the midst of an equity market correction, and most investors, they're asking themselves two questions. The first is, how do I protect my portfolio? And the second is, how do I take advantage of growth assets that are trading at a discount? To help me answer some of these questions is Billy Leung from Global X. Billy, great to have you here.
Hi, Vish. Good to see you.
Good to see you too. So Billy, we've had strong equity market returns over the last couple of years, elevated valuations, and now we're seeing an equity market correction. Should investors be actively de-risking their portfolios, or is there still room to chase growth?
So I think it's a tough question, but I would say that definitely we have to reassess our position. But we're still seeing a lot of opportunities in the equity space as well. So I wouldn't say it would be a full de-risking process, but rather a gradual managing of risk. That would see how I see it. And I think one thing to look at, especially looking at the US market, is that despite all the valuation concerns, despite all the economic concerns, we're still seeing decent growth in the US. Valuation-wise, in terms of what you get for earnings growth, is still very, very solid. And I think more importantly, what people don't realize, I think especially this year for the US market, is that we're going to see a lot of deregulation policies which could improve the dividend as well. So this could be a lot of supporting growth for the at least the US market as well. But yeah, to go back to your question, I think in terms of de-risking, I would say maybe implement a few sort of different products that could manage your risk within the portfolio, whether it be income, risk management, or even different commodities, simply just to manage your risk. But there's no urgency to really de-risk and go the other way.
Okay, so let's hone in on income, and one of the favorite parts of income within the Australian market is, of course, Australian banks. Now, one of the unfortunate things, is, especially if you think about CBA, is that the yield has been slowly coming down because its price has appreciated so much, and it can only increase dividends so much. Is there a better way for Australian investors to generate more income from the Australian market and bank stocks?
Yeah, no, you're correct. I think in terms of the banks, what we saw last year was huge. I mean, the banks in the Australian market created a total incremental market cap of about 126 billion, and about 70 billion came from CBA alone. So we did see a lot of increase in appreciation in the bank prices. In terms of looking at the Australian market, and not just looking at income, but sort of what areas to look at, I think there's probably two things. So one thing is, like I said, there is a lot of high valuations with the banks. The banks in Australia are trading at about 1.9 times book, globally about 1.2 times. So there is a good reason that banks could be reverting to a more reasonable valuation. In terms of the materials, which is the second largest sector in Australia, that's still very dependent on, I guess, global economies. So I think in terms of opportunities, we can also look at the adjacent sectors in the Australian market. There's also technology, there's also consumer, there's also healthcare. These are all sectors that I guess investors could look at. But going back to your question, yes, there is a lot of potentially income potentials in Australia. And I think one thing that we've discussed in previously has been the Global X Bank ETF, which comprises of Australian banks' debt. This is providing an annual income of about 6% on a monthly basis, and that's a very easy way, a very simple way to have that income generation and still be exposed to the Australian economy as well.
And what's the case for playing the banks via debt versus equity? Is there more stability involved?
Yeah, no, excellent question. I think if you look at the Australian banks in terms of asset quality, it is one of the strongest globally, and that's, I guess, a function of because Australian regulators are so solid as well. And so having said that, in terms of the debt, it is very, very strong, and it does have that element of limited your equity exposure. So you are correct.
So Billy, covered call strategies have been gaining traction in the Australian market. They're very, very popular in Canada. Can you explain to investors how they generate higher yield than the underlying asset class, and I guess the benefits of having these strategies in the portfolio?
Yeah, you're right. So I mean, not just in Canada, I think even Asia as well, we're seeing covered call strategies being very popular among various investors. And I think sometimes when we hear the strategy, it's very daunting because it involves options and derivatives, but it's actually quite simple. Like you said, it simply just includes of buying the underlying stock, whether it's a banking stock or a mining stock, and essentially rating or selling the call of this underlying stock. And in this way, what happens is that you take advantage of the option premium. And so what it really means is that you don't really have huge exposure to the stock. So, the ups and downs, when it goes up, when it goes down, you still have a minimum sort of exposure, but what you're really getting is that option premium that gets on it. So that's what you were saying, referring to that additional income that you get for it. So with a covered call strategy, it's perfect for markets which are relatively sideways or volatile, which means that you don't really want to benefit, or you don't see the stocks falling or rising a lot, but at the same time, it gives you that option premium or that income generation on a regular basis. And I think this is why it appeals to, I guess, US Canadian investors, and also, I guess, to a lot of Asian investors, because it provides that stability of income as well.
Okay, and what options do you have in the market for covered calls?
Sure. So I think in Global X, we try to have an entire suite to provide investors with where they want to be exposed to. So we have the AYLD, which is the Australian covered call product, and that's obviously having the Australian underlying stocks with the option premium to have that additional income. We also have this suite or covered call strategy for the US indices. So for example, we have the UYLD, which is a covered call strategy for the S&P 500, and we also have the QYLD, which is the covered call strategy for the NASDAQ index.
Okay, and what kind of yields can investors expect?
These are from the latest numbers. They're probably going at about close to about 10% or over, about double digits, but it depends depending on the underlying prices as well, and it fluctuates.
Okay, really interesting. Let's move on to gold. Seen as a hedge against market volatility, but we've seen a very, very strong rally in 2024, and investors are wondering, is there still room to run? I'd love your views on gold and what you think are the best ways to play it.
Sure, yeah, so gold has always been interesting. It's obviously one of the major outperformers even compared to equities in the past year. And I think in terms of what's been driving the gold price initially in the past is mainly more inflation reasoning. People have expectations of inflation, and this has always been a very good hedge against inflation. But I think the incremental, I guess, positive, or the incremental drive of gold right now is central bank purchases. So what we're seeing now is that various countries are looking into potentially diversifying away from US dollar, inflation hedging, and they're purchasing more gold. And in terms of just putting this into context, what we're seeing is that, on a monthly basis, what really keeps the gold price balanced is a purchase of around 30 metric tons on a monthly basis. But what we're seeing now is that this has gone up to about 50 metric tons. So there is an increasing demand coming from central banks. And there's also estimates that if we see this increase to potentially 70 metric tons per month, gold price could easily surpass 3,000 level. So I think in terms of potential, it really depends on central bank purchases. In terms of potentially being in your portfolio, this could be both an inflation hedge and also a growth opportunity as well.
Okay, now your colleague has written a pretty spicy piece on Livewire about this, gold miners versus gold.
Exactly. So this is a piece by one of my colleagues, and this is exactly what he's writing about as well. So potentially, there is that, view of whether or not we buy gold miners or gold, and, both have its merits. But if you look at sort of gold miners, obviously you're exposed to the equity and also the performance and operational risk there. But if you look at simply buying the gold as well, this could be a very good sort of complement in terms of both, because you're riding on that incremental gold demand from central banks.
Okay. Alrighty, and let's turn to defensive positioning. What are some of the most compelling low volatility or multi-factor ETF strategies today? And this is really for investors who, they want growth. They don't want the volatility like we've seen in recent days. Russell 2000 down nearly 20%. How do they manage that?
Yeah, that's exactly what a lot of the clients and investors are coming to us with as well, because they're seeing a lot of volatility. They still want to be exposed to the market, but where should they be? And something that we've been discussing with our investors and clients is our US low volatility, high dividend yield product. And that's really interesting, because when you have that low volatility factor, like you mentioned, that multi-factor, that obviously eliminates that risk of volatility. But the high dividend yield also allows us to have that selection of sectors. So what we see with for example, our ZY US product, ETF, our US high yield, low volatility product, is that it's actually exposed to sectors which are you don't find in the S&P 500. So for example, again, it's very much industrials, potentially healthcare as well. So it's actually a very good rotational or tactical play when you look at this. You're seeing high volatility now. You can also look into this sort of ETF where it provides these different exposure for a lower volatility and potentially higher yield in the longer term.
Okay, all right, Billy, thank you so much for educating us on what options investors have to protect themselves and also generate higher income in this market. Really appreciate it.
Thanks, Vish.
No worries. I hope you enjoyed this video. Please give it a like, do subscribe to our channel, and make sure you do thorough research before investing in any of these products. My name is Vishal Tekshanani. Good luck with your investing strategy and riding out this market storm.